Welcome back. Tough choices over the next few years as South Africa finds itself at a crossroads. The medium-term budget has highlighted stunted growth, a rising debt forecast, and poor tax revenue collection. So how well did Finance Minister Tito Mboweni walk that tightrope? Let's find out from Senior Executive for Tax at the South African Institute of Chartered Accountants, Peter Faber, Matete Tulare, Client Structurer at RMB, and Head Retail Investment Specialist at ABSA, Tsitsi Atendi Matikai, joins us from Cape Town. Thanks so much for your time, all of you. Appreciate it. Tsitsi, let's start with you since we have you up on screen. Let's look at the broader view and whether the right moves were made given the wiggle room that the minister had.
So if one looks at the markets, as stated by the previous commentator, the markets didn't receive it well. But then if you read a bit further, if you listen to the tone of the minister, one understands that as much as this wasn't really his budget in terms of up until the point of writing the speech and getting the speech out, but his tone was very strong and assertive, and this is exactly what markets needed. And then we also start thinking about the expenditure ceiling being intact, and that's quite important. The numbers are terrible. They're not great, and much more slippage than anticipated, but one has to hold on to some hope.
Yeah, some hope. I think we all always want to have hope. Peter, let's move on to you. The revenue collection in South Africa will fall short by 27 billion rand this tax season. The numbers are bad. Tsitsi mentioning the bad numbers. Let's take a listen to what the Finance Minister had to say, and then we'll talk about it in a moment.
Latest estimates, however, suggest that the full year collections will be 27.4 billion rand less than expected, of which 20 billion rand reflects increased VAT refunds, and 7.4 billion reflects lower corporate tax and personal income tax. We expect revenue shortfalls of 24.7 billion in 2019-2020 financial year and 33 billion in 2020-21 financial year relative to the 2018 budget.
Shortfalls, lower than expected, billions, those are not numbers we want to hear in the medium-term budget speech.
Well, I think importantly, what is interesting is the reason for the shortfall in the current year, namely the 11 billion in historical refunds and the 9 billion also in the current year that have been withheld and that will essentially be fast-tracked. And I think a lot of businesses will be happy that that's happening and that will happen. But it also talks to the long-term problem we've had in that. So to a large extent, if you actually look at the remaining amount, which is only 7 billion, that's not that far off, even though. So going forward, it is actually surprising that the deficits are actually so large, going up to, I think it was just over 30 billion in 2021. But we do see the projections on tax buoyancy, or namely the rate at which revenue collections are keeping pace with inflation. That's estimated to go down significantly over the next few years, which is quite interesting, and that's probably why we are seeing that adjustment of under-collections in future periods.
Matete, we watch the markets very closely whenever any finance minister speaks, especially when it comes to the medium-term budget and, of course, the budget speech at the start of the year. We saw the rand dip a little bit. The market's not very positive at the end of business.
Yeah, look, it was a tale of two halves today, if you want to look at it. In the morning session, the rand performed really well, as well as the local bonds. We did see offshore and local buyers having some sort of optimism, thinking that there will be some sort of fiscal consolidation and tightening from the new minister. But, as the headlines started streaming in at 2 p.m. and all the bad news came out from Mr. Mboweni, the rand started retreating and it lost a bit of ground. We went from being the best performer to being the biggest loser on the day. And if you just look at the bond market, we are unfortunately at the weakest levels of 2018. So unfortunately, as I say, a tale of two halves. So we're seeing the rand at the moment around the 14.59 levels, and that's I think close to a 1.5% loss on the day.
Yeah. Do you think we'll get a more positive reaction in the weeks that follow once we see some implementation of what was said today?
I don't think so. I think, if anything, we know the problems have been there. I think we've seen these problems for the past 10 years. It's a case of implementation now. I think we've spoken about the story for more than the past 10 years. So I think, if anything, it's more about implementation and actually, getting that debt to GDP ratio down as well as the budget deficit down.
All right, let's go back to Tsitsi, of course, in Cape Town. Now, the minister says we must choose a path that stabilizes and reduces the national debt. But the country's debt to GDP may rise to 60% in the next 3 years. Let's take a listen to that, and then I'll get your reaction afterwards.
Government remains committed to its goal of stabilizing and bringing down the debt to GDP ratio. In recent months, deteriorating economic performance, revenue shortfalls, and a weaker rand have all contributed to higher debt projections. The consolidated budget deficit is estimated at 4% in 2018-2019, compared with the 2018 budget projection of 3.6% of GDP. After rising to 4.2%, the deficit stabilized at 4% in the outer years. Gross debt is on pace to stabilize at 59.6% in 2023-2024. Other risks identified in the February budget have materialized, including a public service wage agreement significantly above inflation, and the continued decline in the financial condition of some state-owned enterprises, leading to requests for budget support.
All right, given all of those figures, how do we actually reduce the national debt? Is that even possible?
So it is possible, but one has to look at the numbers and start thinking. The biggest jarring thing was the fact that the public debt to GDP ratio being close to 60% is quite alarming. About 5 years ago, when South Africa was investment grade with all the rating agencies, the number used to be 50. So 50 used to be the level where we'd discuss that. After that, it becomes tricky. So as everyone has stated, the only way that you start getting these ratios to look better is to actually grow your way out of it. GDP will allow the equation to improve, and that's the main thing. We need to grow.
Yeah. Now, Peter, let's bring you back in. Of course, we had some good news in terms of sanitary pads, flour, bread and cake. It was flour being added to the zero-rated VAT list. But there are concerns about the delays, of course, in VAT refunds hurting companies. The minister did mention that. We'll listen and then talk about it.
Concerns have been expressed about the slow pace of VAT refunds. We recognize that it has hurt the cash flow of a number of companies, including small and medium enterprises. The acting SARS commissioner is committed to processing the outstanding VAT refunds as quickly as possible. We estimate total additional refunds of 20 billion rand, made up of 11 billion rand to clear the backlog and an upward revision of 9 billion rand for the current fiscal year.
What do you make about that?
Well, I think it's a known problem. I mean, SAICA did research on this back in 2016. The Ombuds office has been reporting out of it, and just before the show, you had the Minister on for small business. We've had undertakings from government that they would be paying small businesses. That's not really materialized. So now we have an acknowledgement that revenue has been withholding working capital from business. So I think to a large extent, come the February budget, we'll be seeing definitely whether that 20 billion actually materialized in being refunded and whether the practices. But I think over and above that, just to tag onto that, when you talk to revenue, obviously their response is that a lot of it has to also deal with things like increased risk and fraud. And when you look at things like the increased VAT zero ratings, that contributes to that load, in that there are just so much more items now to actually audit and see that people are actually using the right rates in VAT.
Yeah. So let's move on to what the minister had to say about the level of global growth and performance of emerging markets and how it will impact the country's growth prospects. Mtete will speak to you about that in a moment, so let's listen to what the minister had to say.
Developing countries are now expected to grow by some 4.7% in 2018 and 2019. For 2018, South Africa's growth forecast has been revised down from 1.5 percentage points to 0.7%. Growth is expected to recover gradually over 2% in 2021 as confidence returns and investment gathers pace.
You listen to that. Do you have any optimism? I mean, can we believe it?
I think it's a case we've seen the the growth numbers being revised downwards quite a few times, and it's just unfortunate that this year we started with Ramaphoria, and I think when we started we had that 1.5% number that everyone is talking about, and then now you're revising it by half to 0.7 and then pushing it out for next year to 1.7. So my only issue is what happens that we're just kicking the can down the road, that if we do see some more whirlwinds and headwinds that we're going to be facing from the global sphere, then you're just going to kick the can down the road again, and then you're going to just revise growth downwards again, which is something that unfortunately Moody's is looking at in terms of the ratings decision.
While I'm speaking to you about this, let's talk about the consumer price inflation remaining at 4.9%. I mean, it was capped between 3 and 6. It looks like we're getting closer and closer to 6%. Are the right moves being made to actually get this right?
My colleague and I on my left were actually discussing it prior to the show to say, it's unfortunate that the Reserve Bank has not acted, forward-thinking. They haven't thought about this. They should have actually started hiking interest rates at the last MPC. We have not seen the R1 increase in petrol prices filter through into the basket. So I think if anything in the next CPI release that we're going to have, we're certainly going to see an increase towards that 6% number. And I think this will put pressure on Lesetja Kganyago and team to start hiking rates. So
were you guys debating or agreeing? Peter, what do you say to that?
No, I think we pretty much agree is that you need to start proactively taking, and in consideration as well, that these things have impacts on indebted. We're one of the most indebted private sectors in the world. So any increase in that rate is going to definitely have even further burden. And by smoothing it in quicker, rather than having larger increases in a shorter time period, is going to be a lot more difficult for people to process.
Tsitsi, let's bring you back into the conversation here. Of course, Finance Minister Tito Mboweni told reporters that if President Cyril Ramaphosa gave him the power to decide, the size of cabinet will be reduced dramatically to 25 or ideally 20. Do you think that's going to happen? And what are the benefits of that? Because we know there are benefits to a smaller cabinet.
So absolutely big benefits, and we have seen a smaller cabinet in previous times. One only questions, is this possible in the current political climate, and is the president able to actually act on that, given that we're going into 2019 election year, and also that his cabinet is a mixed cabinet. So there's always been the talk of there are camps. So it's very difficult for him to then figure out which ones are out and which ones are in. And I think it comes down to which departments are actually necessary and needed. And the previous minister was actually talking about this, where she said some people don't actually need to have a portfolio as a minister. You can still deliver and not be a minister. So these are the big, tough questions the president will have to answer. He might not be able to answer these earlier on next year, but maybe after he gets the mandate from us as the people, if we elect him into office, then he can do that.
All right, guys, let's try and end on a tough, optimistic note. As Tsitsi was mentioning, tough decisions. I want us to end on a tough, optimistic note. Natasha, tell us, what can we look forward to and how can we get everything on the right track?
Well, I think if anything, we need to start putting out the right messages. We need to start implementing everything that we start speaking about. We need to reduce fruitless expenditure, corruption. Mr. Mboweni did touch on that we need to get rid of. I think even the SOEs that have been the bad apples that everyone's been talking about. He did mention the word reconfiguration quite a few times, and I think if anything, that's also going to be a coalition course with some of the unions in terms of privatization of those SOEs. But I think if anything, that's some of the key topics and themes that Mr. Mboweni and team will need to tackle.
Yet we're throwing more money at SAA to save it. Anyway, let me not go back to the negatives. Peter, what are the positives?
Well, I think from a purely tax perspective, the repayment of the VAT refunds is going to start, and the undertaking that we'll now move to a 21-day refund cycle, I think it will be very much welcomed. And I think rebuilding SARS is a big. I think the impact that we've had, I mean, the then Commissioner told us we're only looking at 50 senior managers going. We now know that more than 1,500 staff members have left SARS in the last 2 years. So rebuilding SARS and actually getting the capacity back so that everything starts functioning effectively, I think is good news that we're focusing on that.
All right, and Tsitsi, positive words from you as we end.
I think the shortest thing that we can look to right now is tomorrow and Friday with the investment summit. Much to look forward to. And I mean, the president has already shown us that $45 billion has been committed so far in the last 6 months. And potentially we start hearing more tangible things coming out of that summit. And this is the kind of investment that we need. Solid investment that will go into creating jobs and actually help creating that growth that we need.
All right, thank you all for your time. We do appreciate it. Of course, we'll leave it right there. This discussion continues on NewsHour throughout the next couple of days. We're going to